the Board of Retirement monthly meeting to order for February 16th at 8:30 a.m. So I think we'll start with a roll call. Judy?
Ms. Schapmire?
Here.
Ms. Forrester?
Here.
Ms. Cavanis?
Here.
Mr. Jurdy?
Here.
Ms. Smith?
Here.
Mr. Cromer?
Here.
Mr. Shoemaker?
Here.
Ms. Harris?
Here.
And Mr. Anderson.
Here.
Great. All present.
Great. Yeah, all here. Very good. So, Shari, do you want to do your last meeting and lead us in the Pledge of Allegiance?
Okay. Okay, please join me. I pledge allegiance to the
To
flag
the flag
of
of the United States of America,
to the republic,
for
which
which
it stands,
one nation,
under
under God, indivisible, liberty, and justice for all. Thank you. I love that when we stand up to give the pledge, you can just see our stomachs on the line.
Yeah, that's helpful.
And every
Yeah.
extra pound shows.
Yes. So are there any public comments on items that are not on today's agenda? I don't see any.
I don't see any at this time.
Okay. So let's go on to our agenda item number 1, which is a discussion and possible action regarding resolution 2022-02, authorizing teleconference meetings pursuant to Government Code Section 54953 in compliance with Assembly Bill 361. That allows us to have our Zoom meeting today. Do I have a motion for approval?
I'll move.
Second.
Okay, thanks, Dan and Jerry. We need a roll call vote on that, Judy?
Ms. Schapmire?
Yes.
Ms. Forrester?
Yes.
Ms. Cavanis?
Yes.
Mr. Jurdy?
Yes.
Ms. Smith?
Yes.
Mr. Cromer?
Aye.
Mr. Shoemaker? Ms. Harris?
Aye.
And Mr. Anderson.
I don't take a vote.
Right. Sorry.
I'm just teasing you.
Well, we didn't hear Richard's vote, so I guess you can vote for
Well,
him.
he thumbed up.
Okay, he thumbed
All right,
up.
yes.
Okay,
There you go.
thank you. All righty, thank you. I believe it's later on in the agenda, but we are going to meet in person for March. Is that correct? Or
Madam Chair, we'll be offering a hybrid meeting, so trustees who wish to come to the office can. If the county still has a mask mandate, masks will be required in the conference room for the Zoom meeting.
okay, so we will have this resolution again, I'm sure, for hybrid meetings. Well, let's get on to a very exciting agenda item number 2, and sad in that it's our proclamation honoring trustee and county treasurer Shari Schapmire. And Shari, I am planning to read the proclamation to you, assuming I can find it. Here it is.
Chair Smith, do you have the revised proclamation?
I believe I do.
Okay.
Thank you, Julie.
Uh-oh. That's not good.
It is good. And Shari, I will say that I am going to miss you terribly on this board. You're the one that roped me into it after I roped you into Rotary. So we've known each other a while, and thank you so much for your time. So the proclamation of the Mendocino County Board of Retirement honoring Shari Schapmire for her service to the Mendocino County Employees Retirement Association and the Board of Retirement. Whereas Shari Schapmire has served as a distinguished Board of Retirement trustee since 2007 as the ex officio member by virtue of her position as the county treasurer tax collector. Whereas Shari's exceptional knowledge and understanding of finance and investments and true appreciation for Mendocino County has been a valued addition to the board. Whereas Shari's perspective and thoughtful attention to policy development has helped the board make important investment decisions, retain the best consultants, and apply exemplary financial principles that will guide the board for years to come. Whereas Shari's dedication is evident by having served as the chair for 3 years, vice chair for 2 years, and served on several committees during her time as a trustee. Whereas Shari's valued contributions to MSERA include receipt of 2 favorable Internal Revenue Service determination letters, procurement and implementation of a pension administration system, and successful strategic planning. Whereas Shari has repeatedly demonstrated her commitment to serving as a trustee, exhibiting the highest principles of collegiality and respect for MSERA, its board, staff, and members. Whereas Shari has served the county of Mendocino 40 years and looks forward to retirement. She plans to enjoy her favorite pastimes, including traveling, spending time with her family and grandchildren, and sipping a margarita or 2.
Thank you, Julie.
Whereas Shari has promised her husband Todd that she will take on more household chores,
Oh, God.
even vacuuming, and will learn to navigate travel on her own when she retires. Now, therefore, be it resolved that the Mendocino County Board of Retirement honors and applauds Shari Schapmire for her years of service and expresses its sincerest appreciation. Shari is wished continued success in her retirement and all future endeavors. Dated February 16th, 2022.
Excellent.
Yay.
That's the better version even.
Yes. Shari, you have been a guide for this committee as long as I've been on, and I do appreciate your dedication. Catherine, did you have your hand up? No, I just saw
No.
something there.
I just wanted to say thank you, Shari, so much, and I will sure miss you.
We all will miss you, Shari.
And if
And we-
I may, I'd like to say that I've worked with Shari since 2011 here. So for 11 years in the Treasurer Tax Collector's office, and she's been gracious with her knowledge and her friendship, and has always looked towards empowering her office and serving the taxpayers and working with the board of supervisors to further agendas, including the cannabis taxes and the TOT and bid Airbnb collections that we did some years ago. And Shari's always been a partner, not only to the county, but to all of us here that work with her. And she's just very gracious and kind and patient person. And she'll be missed severely. And I just want to thank her for everything that she's given us.
Beautiful.
Thank you, Julie. And I would add to that I think Shari and I began to work together many years ago when I was president of the college, and she became treasurer tax collector, and the college, of course, had a lot of funds in the county treasury. And Shari, as Julie, you said, a great word is gracious. She really stepped up to help me at the college to understand the investments and what was going on with everything. And the bonds we issued in 2006, we've had a good working relationship, and I do thank you too, Shari. And Jim?
Yeah, Shari, a lot's been said, and I just like to express my appreciation too. Like I said before the meeting, we go back to when we used to snipe the late 1980s. We used to sit in the vault of the treasurer's office and count the cash, because people used to actually use money back then. But no, it's been such a pleasure. And I think especially, I'm just thinking back to the early days of MSERA when we had a lot of, community division and even division on the board and so forth. And you were willing to chair, and just your wonderful even temperament and your your calm and your management of the meetings and so forth was just instrumental in getting through that time and getting Sarah to where it is now. And I really appreciated it then, and retrospectively just see just how wonderful and valuable that was. So thank you.
Trustee Shoemaker.
Jim pretty well covered what I was thinking, Sherry, that this 13 years of serving here, you've been through a lot of changes, a lot of cleanup, and a lot of really good work. And thank you so much for that work here. And I'm really very sorry to see you going. Maybe you'll retire and come back in my position or Jim's position. Good luck.
Thank you.
Yes, Trustee Cromer.
Yeah, Sherry, I feel like I've had the good fortune of knowing you on a personal level for many years. And since joining this board as a trustee and sharing that title with you, I've gotten to know you more in a professional capacity. And more than anything, it's just increased my respect for you and your family. So thank you for everything you've given to this county, and you will be missed.
Yes, Trustee Harris.
I don't really have much of anything to add. All of you have succeeded in taking all the words right out of my mouth, except that on a very personal level, Sherry, I will miss you. I know we all will. And it's not too far for you to come in and occasionally visit and be someone who sits in our audience. So please come back to see us, and I will miss you.
Oops,
You might have withdrawal symptoms, Sherry.
right. Hold on just 1 second. I gotta get my screen back up.
We can see you.
You can see me, but I can't see
Yes.
you. Oops,
We can see you, yes.
hold on just 1 sec.
Maybe you can even come over and show me how to do that. Have them
No,
both
I'm
up.
gonna be on for a
And so
while.
I just want to say a few things. I really thank you for the proclamation and all the kind words. So my,
Richard, we can hear you. Thank you.
so my involvement with Sarah over these past 15 years has definitely been one of the highlights of my career, and one of the things that I've been the most proud to have been a part of. And like people alluded to, we've done so much in the last 15 years. And I don't know if everybody understands how things, once we went independent, when I entered the board was right when we went independent. In fact, I was sworn in January of 2007. And then we immediately started to go independent, and Tim was actually the interim for those 3 months, or not so much interim. I think he had a contract with me. I guess I was technically the administrator for a few months there. But of course, Tim did everything. And then by April, we had gone independent. And so I really got to see this board from the start of where we were to where we are now. And it's pretty remarkable when I think about all the things that we tackled on this board and all the issues. And they weren't simple issues. They were really complex. They were difficult, at times really overwhelming. And we're still facing that just in the last year or two. I mean, we're still facing these overwhelming issues. But what I see, it's the strength of this board. The trustees on this board are just amazing. And it has been an honor and a privilege to serve with you, as well as all of the trustees that I've served with over the years, because there are a lot of really, really special people that we have been blessed to have on this board, and also administrators and the interims, Jim, and some of the other ones who took a crack at holding us together when times where we were kind of in between administrators in different times, and it's been a struggle. But what I've seen is I've just seen this board, it just got stronger and stronger and stronger, and it has become this board today where it's really, we're a trusted board, and like what was said, we had a lot of critics when I first started, and though they've gone away, I think that the public is very happy with this board, and it feels like, we are stable, we're professional, we're just a great board. I want to talk a little bit about the staff. We are so lucky to have the staff, and it has been such a pleasure to work with Doris and her team, and particularly Judy, because Judy has been the mainstay that has kept us together and on track and heading in the right direction for pretty much the entire time that I have been on this board, it feels like. So I don't know, I mean, for a good chunk of that time. And so then, of course, Robert and Nora and Katie, who is hopefully enjoying her retirement and having a lot of fun. So they are definitely the glue that holds this organization together, and we need them to remain strong, and they're doing that. I'd also like to thank all the professionals that we have. Jeff he spent years and years keeping us on the right track, and I don't think that we would be where we are today without his guidance. He's like Judy. He has been a mainstay for this board for at least probably over a decade. And then also all of our contracted, all of our contracted professionals, my personal favorites, Callan and Siegel, and I'd like to, thank all of them. You guys have all taught us so much, and just me on a personal level, I feel like I have learned so much over the last 15 years, and I will also miss all of you, and this has been a great ride, and I'm just glad to be a part of it. So thank you.
Thank you, Shari. Are there any public comments regarding the proclamation, or I will go to the consent agenda next? Are there any public comments regarding the consent agenda?
We do have public comment regarding, I believe, Shari Schapmire. So I'm going to let
Great.
John Almeida speak.
Great, thank you. Yes, John. Yes, John.
I wonder if he's having difficulty. I know he wanted to speak.
I see his name with his hand up, but I can't hear him.
No.
Well, I think John will need to go on, but if you can get your system working, we'll let you in anytime. Judy, are you?
I'm gonna just try promoting him up and see if that gives him the
Okay.
ability to speak.
Okay. Yes, John, are you
Can you
able
hear
to
me?
hear?
Yeah.
Yes, thank you.
Okay, I pressed enough buttons, finally got it. Anyway,
Good.
Shari, my name's John Almeida, and you probably remember me. And I worked for the county for a couple of decades there. And of course, our paths didn't cross until you were on the retirement, or I retired and you were on the board. And I just want to give you the thanks that I have and the respect that I have for your position. You've been a dedicated employee. You've been a champion for the retirees, and I've watched your dedication and your humbleness and your concern and care for the individual, and it means a lot to me. I don't believe the county realizes, a lot of the people don't realize what they're losing, but I'm hoping you stay engaged. I remember the time that you talked about the one loan that would be paid off, and you were hoping to be able to roll that funds over into the unfunded liability, and I'm hoping that goes through, and I hope you stay engaged with that. Please stay engaged with the retirement board. You're very valued, and you have a lot of knowledge in what you do, and I do praise you and applaud you and hope that you have a great retirement, but please stay engaged. Thank you so much.
Thank you, John.
Thank you, John, for those comments. Well, Sherry, we all wish you luck. We're going to move on to the consent agenda. And of course, you know, we'd love to have you participate in the rest of the meeting, but if you disappear, nobody's going to. So are there any comments on the consent agenda? Does anybody want to take anything off, or are there any public comments? The consent agenda has the minutes of the January 19th meeting, the January 2022 retirement report, and the monthly financial report. And the minutes of the workshop will be presented as part of the March packet.
Chair Smith, if I could mention for the benefit of the rest of the trustees, there was an updated January 2022 retirement report posted, I believe it was this morning, just to correct a typo in the totals of the active membership.
Thank you. I was going to mention that, but forgot already. So anyway, thank you. Well, if there are no questions or comments about the consent agenda, we will consider it adopted by consensus or approved by consensus. And we will skip item 4, the discussion and action regarding any consent item needing separate action. And we will go on to item 5, which is discussion regarding the historical benefit review, project status report, and project updates. Should I ask for any public comments first or after?
After.
Usually after. Thank you, Jeff. Okay, Director Rentschler.
Thank you, Madam Chair. There is actually an updated benefit review report that was posted yesterday, and that just incorporated the change brought forth last month that item number 18 wasn't on the list of error descriptions. That was listed as the top as Alameda, but at some point I had changed it from being named Alameda to being encompassed in item 17, and item 18 is the inactive interest. So the new report just corrects that list of error descriptions. So the report provides data through the January corrections, and if you have any questions regarding anything regarding the correction project, I'd be happy to answer any questions.
So any trustee have a question or comment?
Comment.
We're okay. Jerry
Now,
or Trustee Harris.
You.
I'm sorry, what?
I'm just telling Doris that I like the picture on her wall.
Oh.
I'm pleased that that is there.
I lifted that out of Katie's office when she retired, so it would not be blank back there just for you, Jerry.
Thank you so much, Doris.
And I didn't even notice, but anyway, I think the report that you present every month, we've gotten familiar with and are used to reading it, and I appreciate all that detail, and thank you for that, Director Rentschler. Any public comment on the historical benefit review report?
Does not appear we have any public comment at this time.
Okay. Agenda item number 6, we will welcome our financial consultants here. Discussion and possible action regarding investment matters. And we have 3 topics under those, and I will turn it over to Mr. DeForest to do whatever order he would like.
Well, thank you so much. And before we get started, I'd like to congratulate Shari for a wonderful career and thank her so much for the partnership we've had for the past decade plus. It's been a pleasure working with you, and you have been a steady hand over this long time period. And the actions of this board does have direct impact on the performance of the assets in the plan. And staying steady and not chasing fads and weathering the storms is one of the hardest things to do in managing investment programs. And you've done a wonderful job for that for the past 10 plus years I've worked with you. So thank you so much for your partnership. And I do wish you the very best in your retirement, and I hope you have a lot of fun.
Thank you, Greg.
So we really have a couple topics to talk about today. We've got performance. We'll talk about performance, and we'll focus on fourth quarter. And I'm going to call that the Shari high water mark, because at the end of the year, returns and market values looked higher than I had seen it for this plan. We've given up a little bit of ground since January, and but end of the year will be the Shari high water mark for us. So we'll spend some time talking about that. But before we get into that, we have Jay Klepfer joining us. And Jay is a member of our capital market research group. He's an economist. And he, along with his team on an annual basis, come up with long-term return expectations for our investors. And so Jay was going to walk through the capital market backdrop and communicate to you what we expect long-term returns to be for the plan going forward. So Jay is going to spend maybe about 30 minutes walking through that presentation. There are no action items at the end of the presentation. This is more educational in the FYI perspective. So with that, I'm going to hand it over to Jay. And would it be helpful if I share my screen?
Yes, thank you.
Please.
Okay. All right. So
Great. Well, good morning, everybody. It's nice to see many of you again. Welcome to the crazy world of 2022 capital markets. As Greg suggested, we've had a little give back this year, but I'd lead off by saying that of all, I've been working at Callens for 24 years, and before that I was at S&P for a dozen years. I've never seen a year like last year, or the last 2 years, or the last 3 years. And if anybody thinks they have, they're mistaken. This is a very unusual period. For a lot of our investors who either if they had a fiscal year that ended in July or June or December, likely the best year return they've ever had in their career. Second, the emergence of inflation. And for many, I'm old enough to have been around the last spike, but for many, this is the first time they've ever seen inflation in their lifetime. So it's a very interesting period to go through. Greg, if you could move ahead to slide 5, I'll do just a quick summary of why we do this. We set capital market expectations every year. We start in September, we release them in December. We use them to guide strategic planning. So we've done asset allocation work for you every year since we've been engaged. We do asset liability studies every 5 years. And these really help set the ground rules. So it's a midpoint of a range of returns for each asset class and then what the total portfolio looks like. And we have to be cognizant of what kind of change we'd suggest to a long-term investor based on one more year's information. So that gives you an idea that we're going to be somewhat careful about letting what just happened be a tail that wags the dog of a long-term forecast. But we do acknowledge what's just gone on. And then the other thing to point out is that there's a lot of users for this information across Callens. So we work with public defined benefit plans like yourselves, but also your DC plan, for instance, not yours, but others who have DC plans, as well as corporate plans, pools of assets that aren't pensions, endowments, foundations, et cetera. So they really get used across our client base. Underlying this all is, if you go to the next slide, just a series of quick beliefs. What do we believe in? Well, there's long-term averages we're going to revert back toward, but sometimes it takes a long time to get there. The path to a 30-year return includes 10 years where they look phenomenal, like we've just enjoyed, and 10 years where they may not look so phenomenal, which is what we're suggesting for the next 10 years. We do a lot of the modeling at the individual asset class level, then roll it back up to look at the total portfolios and everything. We try to make it cohesive in terms of an outlook. I'm going to move. Slide 7 gives you a depiction of what the projections look like. I'm not going to dive into them yet, but to highlight, they're broken up into categories of equity, fixed income, and alternatives. And then at the bottom, note inflation at 2.25. Cash is at 1.2. It's up a little bit, but if you take out inflation, it's still a negative return for cash for the next 10 years as interest rates rise. Core fixed income in the middle of the table there, the second line down, 175 for core bonds. So positive return, but when you take out inflation, it's not keeping up. And then equity up top, 6.5 for large cap equity, has a real return then of 4.25. Compared to long-term history, that's quite muted. so is the nominal return. So it's an expectation of muted returns looking forward, and built into that is an assumption that interest rates will rise as we move forward in our economic cycle. If we move to slide 9, please. I know you'll cover this in performance, but I just want to highlight these are returns for indexes across different asset classes for 1 year, 5 years, 10 years, 25 years, and it has the most recent quarter through December. Look at that 10-year number for the S&P 500, 16.5%. Absolutely phenomenal. If you compare that to, if you take out cash to get at this notion of a Sharpe ratio and divide it by its risk, one of the best Sharpe ratios ever seen for equity. Over the long-term history, equity Sharpe ratio is about 0.4. Last 10 years, it's been like well over 1, which is a phenomenal number. Non-US equity, though, look at that. Strong returns, but half or less of what you got in the US market. Fixed income returns about where we expected them, but cash much lower than we would have expected, say, 10 years ago, looking forward. And finally, under the alternatives, hedge funds doing exactly what one would expect, private equity doing very well, but look at that, commodities. It's very difficult to hang on to commodities as people have tried to pursue some sort of real return. But it's been a phenomenal result for the last 10 years. Great news, got one of the best years ever. More sobering news, it's not going to look like this going forward. If you turn to the next slide, please, to put things in perspective, this is the return from peak to trough, cumulative return for the last 3 drawdowns. And then for the last year, I added in, the continuing on once we recovered. So the dark blue line is the tech bubble, took 2 years to bleed down about 50%. The teal line is the global financial crisis, a little less time. These are across trading days, but more than 50% decline. Then what happened during the pandemic? Steepest decline ever, down 34% in just 23 days. Got back to where we needed to be by August of 2020. And then just this rocket to the moon since then. The S&P is up about 100% over the last 3 years. That's just a phenomenal result. To put these in another perspective, if you go to the next slide, these are returns for the S&P 500 in 10% increments, and then stacked in reverse date order. So the most recent are on top. So you can see 2021 is highlighted as red, 28.7%. Phenomenal result. Where was 2020? Well, it was right next door at 18.4%. At 2019 at 31.5%. It's been a remarkable 3-year run through what was ostensibly one of the strangest and most severe depressions we've ever gone through with regard to the economy. So again, it's just a remarkable period we've lived through. So now what about GDP? This is an underlying component of our forecast. If we go to the next slide, this is GDP growth on an annual basis. You can see the decline in 2009 and then again in 2020. And then just remarkable results for 2021 and then a forecast for 2022. We still expect GDP to subside as we work through the problems of the supply chain issues and mismatch in the labor market. Our expectation is that GDP will average 2 to 2.5%, so right at the midpoint of 2.25 over the next 10 years, including this year. So we'll have this very strong year this year, which is the rightmost, somewhere around 4%, and then tailing back down to that 2.5% range. It's really a different world. From 1965 all the way through 2007, we averaged between 3 to 3.5% GDP growth. That's not going to be the case going forward. We already saw evidence of that in the 2010s. Just one more quick look at GDP on the next slide. You can see just how severe that drop was. Steepest recession in 75 years. We've already recovered where we were in terms of level, and we're marching forward from there. Why do we forecast these funny variables like GDP and inflation? Well, we think they actually set the underpinnings for investors. GDP forecast, that's really all the activity in the economy, is a good rough estimate of future earnings growth over the long term. Earnings drive what happens on your equity portfolio. Inflation forecasts provide a pretty good short-term path or a pretty good path for short-term yields. Now, I say that, and inflation hit 7% in December and 7.5% in January. phenomenally high numbers we haven't seen for decades. I'll talk
Jay,
about that in just a minute. So go
Can
ahead.
I interrupt you?
Yes.
I see that Trustee Anderson has a question or comment for you.
Sure.
Yeah, Jay, I was just curious when we look at these numbers, the recovery, the GDP, all of that, from does that somehow include these trillions of dollars of government infusion and so forth? I mean, it seems like we're hearing two stories, that these numbers look great, but you look out there and there's business closures, there's people can't find folks to employ. And I'm just wondering, like, how real it is, or is it like a facade of good news?
No, it's a good question. I mean, all questions are good, but that one we have been thinking about. It's not a facade. These are real numbers. Almost 6% GDP growth last year is a real number. Now, what was its cause? Yes, there was a lot of stimulus from both spending as well as from the monetary side. So the Federal Reserve stepped in and lowered interest rates to zero to keep borrowing costs low. They went out and purchased bonds across a variety of different types of industries to provide liquidity, and they essentially stopped what was the steepest decline ever in GDP from getting worse. We also stepped in and provided on the financial side, extended and enhanced unemployment benefits for a long period of time for a lot of people. And we provided PPP loans for businesses to help them stay afloat, even though they couldn't operate properly. And there was others, and then direct grants to individuals. We got checks in the mail. So as a result, all that pent up cash, money, addition to savings was available to keep the economy moving. So it's absolutely real. But you're right to point out, well, what does that mean going forward? Well, we're already tapering away from what the Fed has operated. It is a taper where they stop buying so many bonds. They've already announced they're going to raise interest rates from zero. All of the support that came through the unemployment system, both the federal and the state level, has stopped in September. And I don't believe there's any more PPP loans being made, but I could be wrong there. So all this stimulus is being withdrawn. What does that mean as far as we're concerned? That's why we have a forecast of 2 to 2.5% for GDP, not 5%. Other questions? All right.
So
Yes.
Jay, I have a question. Earlier, you showed a chart that showed the 25-year average for the Russell 3000 was maybe like 9%. And but you're projecting forward for the next 10 years, I think it was around 6, and with an inflation background of 2.25, so real returns of about 4.5, something like that.
Yeah.
So is it principally that you're seeing less GDP growth, and therefore there's just going to be less growth in the Russell 3000 and the stocks?
Yeah, there's several components there. We try to build from the bottom up and look down from the top down. So you're right. Earnings growth is going to be slower because we think GDP growth will be modest. Inflation, you add to that, you get a nominal earnings rate of growth. There is a return associated with free cash flow. Sounds very fancy, but think of dividend yields. They've actually come down. And then there's a return associated with expansion of the value. We think that's actually going to be negative. So it's going to have stocks are very richly priced. So you add up all those components, we get to a 6.5. And you're right, the long-term return here is 9.76. If you go back even longer, it's more like 10, almost 10.5. So our return expectation is 3% or more per year below this long-term average. And it's a sum of these components: lower earnings, already richly priced stock, a subdued dividend, and modest inflation, or at least more modest than what we're seeing right at this moment.
So just to follow up, but where else are people going to put their money? Like everything else everything else that chart performs worse.
Well, and actually that's some of the support for equity, frankly. If you we are, believe it or not, on the optimistic end of the spectrum of those who do this type of forecasting. There are many out there with 4 and 3 and 2 and even 0% equity projections for the next 10 years. that the excess needs to be wrung from the system. We're not believers in that particular strain of thought. And I do believe that, there is a, what was the acronym used last year? TINA. There is no alternative when it comes to investing. So there's still a lot of interest in investing long-term in equity. And we think you'll get rewarded, just not the level of reward we got, say, the last 25 years. And I know that's going a bit out on a limb to say so. Why would we not repeat history? Well, we have to be able to replicate all the situations that gave history to us. And we think there's some unique situations going forward. Low interest rates, they will be rising. That harms actually both equity and fixed income in the short term. But in particular, fixed income, as we'll see, I'll show you in a minute, you actually suffer some loss while rates go up, and then you get to collect a higher yield. Equity doesn't like rates rising either, but over the long term, they'll be fine. It's just the path, in our opinion, this notion of the path to the long-term return requires 10 years where maybe they'll do really well, and 10 years maybe they won't do as well. This is going to be one of those 10-year periods where we don't do as well as the long-term average.
Any other questions? Thanks, Jay.
Sure. Let's move ahead to talk about fixed income first. Actually, let's talk about inflation. I do have some slides in here on inflation. It is topic, that's top of mind. What I'm showing you here is the Personal Consumption Expenditures Index. This is actually what the Fed looks at. So they're certainly aware of CPI, which is the headline number. The consumer personal consumption expenditures is calculated in a different fashion. It's part of the GDP accounts. And it typically is lower and doesn't move as much as the CPI, but there's still a relationship, obviously. So when you see CPI, being or the Fed touting a 2% goal, CPI is typically going to be 2.25, maybe 2.5. But what's very interesting, you look over this history, anytime we got near the Fed's goal of 2%, either events overwhelmed or the Fed stepped in and started raising rates and we never got up above 2. So how can you average 2 if everything's below it? So there was a change in the Fed's framework, which I've sort of put in the title here, which is they were going to let inflation run hot for a while so they could get to an average of 2. But then look at the spike since 2021 began. Now, was this spike expected? I would argue it was. Does it make headlines? Absolutely, because it's alarming and we haven't seen anything like it. If you look past history back to 2008, we haven't seen anything like it for 15 years. So of course it generates headlines. But you think about all the kinks in supply chains, and then the dislocation, the massive dislocation imposed on the labor force, and then the fact that we went through a recession, and while individuals are clearly harmed by it, on average, personal income didn't go down because of all the support. Big shift from wages to transfer payments in terms of what's supported at the average personal income. So we've never had a recession where 20 million jobs went away, yet personal income didn't fall. So there is a lot of pent-up demand for goods. There are supply chain kinks. I mean, the stories are apocryphal, car lots full of cars that can't go anywhere because they need a $50 chip to operate. That's supply chain. It's not that we want more cars per person. And in our opinion, as we look forward, 2 years from now, 3 years from now, we won't be buying more cars per person. We won't be buying more clothes, more food, etc. per person. We have to get through these supply chains. The one caveat in all of this stuff that's been very hard for people to understand is housing. Housing is very poorly measured by the CPI. It's imputed rent to owners. I mean, I have trouble explaining it to myself, let alone explaining it to others. So it's, I tried to explain it to my mom and she's like, no. So it's, essentially, it doesn't do a good job of capturing it. The other important part is if your rent goes up $100 and doesn't go up again, it's still $100 more than it was forever. So it has a real impact, especially, the lower income you have, the more you're likely spending on the very items that seem to be spiking in terms of price. The next slide gives you an idea of what the headline numbers look like, which has the CPIU, which is the headline number, that's dark blue, the producer price index, all the commodities they purchased, and then final demand. And so obviously you see that big spike, and it jumped again in January. But notice that there is a base effect. So prices fell, especially on the producer price side, before the pandemic started. In 2019, commodity prices had started falling and they went to the floor. Does anybody remember that in mid-2000, the price of oil was essentially zero because no one could ship it? I mean, it's hard to remember that as it shot back up toward $100. So the base effect has a big impact here. And then when you look at what's going on with the CPI, these numbers like 7.5, a quarter of that's coming from energy. What's really interesting too, someone in my group did an analysis. Where is all the rise in prices coming from last year? A lot of it had to do with transportation, so cars as well as the actual shipping and etc. So a lot of these are supply chain kinks that we think will work out. Now, having said that, when you're sitting in a fire of 7.5% inflation, it's kind of cold comfort to know that, well, it'll go away sometime in the future. But the Fed is moving fairly quickly. There are 3 rate hikes planned for this year. The market has priced in 5, and I've heard commentators saying they're going to have to move as many as 7 rate hikes. That's 0.25% per rate hike. The final note on inflation, I would turn to page 19 if you can. One more, please. The price of gas is often, now this is a national average, so it makes us chuckle here in California as we're forking out $5 a gallon. But the average price of gasoline is often the price that most people are aware of, because you think about it, you drive down the street and there in 2.5 foot tall letters is the price. You see it every day. So as that goes up, that's often people's indicator of prices going up. What I thought was interesting when we put this chart together was they're still not as high as they were from 2011 to 2014, and we lived through that period just fine. It's painful and it's expensive, and obviously affects those on the lower income spectrum because it's more of what they're spending. But the price of gasoline, I also believe, is somewhat temporary in terms of these supply chain kinks and politics. And I'm not really good at forecasting politics right now. So there's definitely some risk here. All right, everything I've discussed about inflation is in words on page 20, so I won't touch on that. And instead, let's move ahead to fixed income in the interest of time. And Greg, if you could move to slide 26. This is a good depiction of what our expectations are. This is the yield curve path for various parts of fixed income. So up front, we're assuming interest rates will rise. We've said this last year and we were wrong. They moved up a little bit, but not as much. Essentially been pushed out a year. And much of the rise is concentrated in the first 5 years of the forecast. That's the steepest part of this curve. But we have interest rates rising. I mean, what are some of our guidance? Well, the Fed is saying federal funds rate will be 2.5% sometime in the more distant future. So that's one of the targets we're working toward. So you can see the final yields listed in the second column over. So we have, a TIPS yield out at 4.25. We have the aggregate treasury component of the aggregate getting up to 4%. Again, these are all treasury components of the yield. So we do have rates rising. And what happens when you have rates rising and you hold a bond portfolio? Well, you lose money up front, then you get to collect a higher yield. So it's a matter of how much it goes up and how long it takes. If you turn to the next slide, page 27, on the left is really the highlight. That's the yield curve September of 2020 versus September of 2021. So rates have already moved up, mostly on the short end, and the yield curve is steeper. A steeper yield curve is positive for the economy in that it means there's expectations for growth. All right, so because the yield curve is really reflecting investor expectations. Page 28, while busy, gives you the best flavor for how this traces through to the bond market. So if you could go down one more page, please. This is the year by year. The total return is the green at the right of each set of bars. So as interest rates rise, you suffer capital loss. That's the teal bar that's negative. But the yield keeps getting higher. That's the nominal yield. That's the far left dark blue. So somewhere around 2023 into 2024, we start seeing positive return from this after the rates have risen. And then you get all the way out to 2031, you can see the yield is higher than the return all the way across, but we're expecting an aggregate yield of 3.4 and a total return of 3% by 2031. And then I'm going to skip through the discussion of high yield and TIPS let's talk about equity. If we can go to slide 35, please. Earnings has really been one of the big stories. While prices have shot through the roof, earnings have done really, really well. So measurement of the equity market has been surprisingly less alarming than I thought it would be. And part of it is, I mean, look at these expectations for earnings. So 2021 is a projection that was made in September for where earnings growth would be. But you look at some of those numbers, they're outstanding. And the S&P 500 is right in the middle. So S&P 500 earnings growth through the end of 2021 was almost 60% or almost 50%, 45%. But even for 2022 is 9.2%. That's a phenomenal growth rate. And you know, part of this was there was really poor earnings in 2020. So again, you have this base effect that drove it back up. But earnings have been really, and so how you see this translate is if you turn to slide 36, you can see the price level, which you know alarms everyone when you see how high it's gone up in the S&P 500. But if you turn one more slide, you're looking at the forward price to earnings ratio. And oddly enough, it kind of stayed flat for 5 or 6 quarters there. And that's the earnings effect. So you're dividing price by earnings, and earnings went up too. So it's clearly one standard deviation above a long-term average. That's the dark green line. And you can see all these measures in this table of valuation. So there's the forward price earnings ratio, and then it's long-term average. The Shiller's PE, which is another measure, it's the cyclically adjusted price to earnings ratio. It's also much higher than its 25-year average. The dividend yield is low. The price to book ratio is a bit higher. So every metric, there's no doubt the market looks rich. It just surprises me that it doesn't look richer. And that's because we've actually performed pretty well. The companies that make up the S&P 500. The other interesting point is it's been a large cap market. So you turn to the next slide. No, you got it right. Page 38. Small cap under its long-term average. Mid cap under its long-term average. So the top is mid cap and the bottom is small cap. So substantially under that long-term average. Let me wrap up this idea of where we're thinking about for equity. I want to go to actually what I think are interesting charts are slide 40 and 41. There we go. The source of return. So we have an expectation for the U.S. equity market of 6.5. We have the same for the developed markets overseas, but we get at them from 2 different angles. In the U.S., growth has really been driving earnings, and then the dividend yields has actually gotten weaker. So the combination of price of growth in the portfolio, as well as the earnings, as well as the dividend yield, you know, it's really dominated by growth. Whereas when you look at the non-U.S. portion of the market, the yields have always been a much more important component in Europe, the United Kingdom, Japan, and Pacific ex-Japan. So we get at them from 2 different angles. The way to look at this, if you go to slide 42, there is a depiction. This is a very complicated looking slide, but let's just walk through the S&P 500. We have the first one shows where the current dividend yield is. The second one is what's our forecast, which is 175. We also believe there's still been a lot of buyback activity, which is companies buying back their own stock to increase shareholder value. And that has been a positive at the S&P 500 level. And then as you see, it traces down to the Russell 3. Why is it such a negative in the emerging markets? Massive issuance, diluting value. That's just the nature of growing stocks, or growing stock markets there. And then you can add in inflation to get to a nominal earnings component. And then we have a negative valuation adjustment for the US because the market's rich. So that's how we end up at 6.5%. And you can follow this through for each of the components. And again, you look at the world ex-US, the 4th line down, the dividend yield is 1% higher. There's no buyback yield. There's no adjustment for valuation because it's actually under its long-term average, but there's a lower earnings growth. There are several slides here that talk about alternatives here. I don't have the separate page here for private infrastructure. Our projection for it is in this table, however, on page 50. And these, again, looking at our assumptions, 2.25 at the bottom for inflation, 1% for cash, 175 or 1.2 for cash, 175 for fixed income, 6.5 for equity. And then you can see the infrastructure expectation at 610. As we take this through to your portfolio on page 52, this is your target that you adopted. That includes the infrastructure allocation, the 11% to real estate, and then 21% to domestic fixed, 25 to global ex-US fixed, 37 to the US equity market. Our projected, the second line down is the one that matters. That what's the compound expected return is 6%. It's the same as what we projected a year ago because we didn't make many changes within our projection this year. Really, a couple of categories of fixed income that you don't have direct allocations to, tips and high yield. And the standard deviation is essentially the same. So 6% compound return over 10 years, that's net of fee. It does not assume active management. The range of potential outcomes on page 53. And the idea here is we do simulation work, what's the widest range of outcomes over a 1 year, then a 3 year, then a 5 year, and a 10-year period? Why do they get smaller over time? Well, in any given 1 year, you could have a pretty wide range of results. So from -15 all the way up to 30%. We were near the upper edge of that this last year for many of the plans we worked with. Over 10 years, however, what happens is bad years, are taken care of by good years, and the range of potential outcomes narrows. The middle of those floating bars is our expectation of the 6%. But still, there is a chance over a 10-year period you have a negative return compounded over 10 years. That would be a terrible outcome. And we give that a 95th percentile expectation. I think the last chart I want to talk about is on slide 58. This is a thought exercise we go through every year. On the rightmost is our set of expectations for 2022. And if a client asks me, what do I need to do to get to 7%? It's you need to take a lot of risk. 96% in growth assets. Since we've been doing this a long time, the question was posed, well, 15 years ago, what would you have told me if I needed 7%? That's the middle circle. It's about half in fixed income because our expectations were higher. In 2007, I think our fixed income expectation was more like 5, not 175. And then if you went all the way back 30 years and we had expectations then, what would we have said? You could have got there with half cash and half fixed income. Our cash expectation was like 6.5%, maybe a little bit higher. What I'm trying to get at here is these aren't portfolios people actually pursued, but the notion is there's been increasing complexity in pursuit of return, and this has been across all of our investors. Of course, making us look like fools is you have a 10-year period like just happened where equity was at 16.5%. Not what we'd expected 10 years ago, and it's not what we're projecting going forward. So I'm going to stop there. I think we're right at about 30 minutes. And entertain more questions, or Greg, I don't know if you have any more that you would like me to speak to.
Does anyone have any questions for Jay?
I don't have any question, but Jay, I do appreciate it. I looked through the presentation before, but your dialogue really helped me understand more of it. So thank you.
You're welcome.
The one page I would emphasize is here on page 53, where we show that over 10 years, we expect our base case expectation is that 6% return. But in any one given year, if we lose 15%, we expect that's going to happen once out of every 20 years. So that would have happened 2 times in Shari's career, where the total plan is down 15% in any one given year. That would be normal. That would be normal. So we show this chart to just give you the range of outcomes in any one year and to demonstrate that to get that 6% return, you actually have to withstand a good amount of volatility in shorter year time periods. And something we talked about last week when we had the offsite was the path of returns is also important. And it's especially true for a mature plan where there's more money going out than going in. And if you have a few negative 15s up front and you have negative cash flow, it's harder for you to get back to that average 6% return in a dollar weighted basis over the long run. And I think that's why your actuary was kind of alluding to, well, you know, maybe we don't need to take as much risk as we used to. Not to put words in his mouth, but that was a little bit of the thought exercise we went through last week. Okay. Well, thank you, Jay.
You're welcome.
We're going to change gears and start talking about plan performance through the end of the year. And as I alluded to, this was the Shari Schapmire high water mark, where the plan at the end of the year hit $712 million. And over the full year, that was $89 million in investment gains. So a lot of that had to do with a surging US stock market and other markets not going down as much as one could. A lot of times you see diversification, you have one market up, one market down. Last year, all the risk assets went up. And so we had about almost $90 million in investment gains and negative $19 million in flowing out of the plan. So really strong year from a dollar perspective. One thing you as a board, you always want to take a look at is my asset allocation close to that which is approved in the investment policy statement. You come up with that asset allocation from an asset liability study. We just conducted one for you a couple of years ago. And we came up with this target asset allocation, including the full allocation to infrastructure. And you'll see here that target and actual allocation were very close to each other. The infrastructure was fully funded in January. So you're right up on target now for that allocation. But overall, the split between stocks and bonds, very close to target. We created that real estate and infrastructure blend. That is designed to be a private asset allocation to reduce risk to the public and exposure to the public market. But it's also expected to be a reasonable inflation hedge over a long time period. It doesn't mean when inflation goes up a lot over a short time period, it will always move in sympathy with it. But infrastructure and real estate are real assets, and they are expected to do well in inflationary environments over the long run. So that's another part of the rationale why we have those investments. We show a little more detail of the how assets are allocated as of the end of December across the individual investment managers. After we did the asset allocation study, we went through and we took a look at each asset class and decided, okay, do we have the right number of managers and the right type of managers in here? So we did that, starting really a year and a half ago and went through all of those asset classes. And so for now, we think you're in pretty good shape. The last major move being the funding up of the infrastructure managers. So how has performance been? Well, it's been pretty good. And so we look at a few things here. What's the absolute return? Over the long run, are we hitting a successful total return? And you'll see over the last 10 years, we've had an annualized return of 10.4% net of fees. So good absolute return. The other thing we take a look at is how are we performing relative to our benchmark? So with that, you compare the blue dot to the green triangle. And you'll see over long time periods, we are ahead of that green triangle. Last quarter, we lagged a little bit, and we can get into that. But most of the other long-term time periods were ahead of that triangle, so that's a good thing. And then the third comparison here is how do we look relative to other public funds about your size? With that, we compare the blue dot to the distribution, and you'll see that over the long run, you're ranking top quartile for 1 quarter and out. Part of the reason you're ranking well is that we have stayed allocated to public markets. Other investors exited public markets and put more money in things like hedge funds or private debt or global bonds or something like that. And we've stayed a little more, I don't know if conservative is the right word, but we didn't chase some of those fads. And I think that's worked out for you very well over the long run. I know Robert likes these charts quite a bit because they show your fiscal year returns. And still a short time period, over 6 months here, but fiscal year, we're just a little bit behind the benchmark and ranking about median. One thing Claire and I always point out on these fiscal year returns, and it was really pronounced more in the past, is that you used to be really high or really low in the distribution, depending on what's going on in the international equity and US equity markets. And we've taken off a little bit of that equity beta over time, and we've increased our diversifying assets over time. So that's largely where we've been shifting over the past 5 years. And we have cumulative returns on page 67. So, and here you'll see the blue line is just a little bit ahead of the green line there, and we like that. But what's more important is the absolute level of the line. And so it's been a pretty successful time period to be an investor. And this is with 2 meaningful drawdowns, right? This is with the 2008 time period, and then with the COVID 2020, March 2020 drawdown as well. Now, we've gotten those returns with a little bit higher risk than the average plan out there. And we've explained that because we've had historically a higher reliance and allocation to the public equity market, and that's added to the volatility. But we've also been rewarded for that. And then, so that's total plan performance. So we always show a chart that explains, well, why did we return what we did relative to our target? And over the last year, we essentially matched our target return. And we had some asset classes that did well. We had a couple that lagged. One, the private infrastructure, not yet funded. So, you know, compared to its benchmark, it's taking about 47 basis points off from the bottom line for the last year. That's a little bit of measurement stuff going on, right? It's not that those managers perform poorly. It's just that that allocation is just ramping up. But we had pretty strong performance from domestic equity and fixed income. On average, the international equity for the year has lagged a little bit. Over longer time periods, the domestic equity fixed income returns have added to the bottom line. And with that, I was going to hand it over to Claire, who's going to spend a little bit more time talking about the asset classes and the individual managers.
Great. So focusing in on just the domestic equity portfolio, we show here the total composite performance for the domestic equity portfolio on the top line, and then each of the underlying managers that make up that portfolio below. So for just the last quarter, and consistent with the strength of the capital markets, the domestic equity portfolio was up 9.2%. And if you look across the longer term returns for the domestic equity composite, they're all double digits. So that's consistent with what Jay talked about in terms of what we've seen out of the capital markets in the last year and longer time periods. Over 10 years, and over 16% annualized return. Now, the other thing we look at, to Greg's point, is relative performance. So the domestic equity composite is compared to the Russell 3000 index. And over the last year, it's outperformed that index, up 27.5% versus 25.5% for the benchmark. Longer term returns for the domestic equity portfolio have been strong as well. Now, digging in a little bit more, about 70% of the domestic equity portfolio in total is allocated to an S&P 500 index fund. So much of that absolute return is driven by the return of the S&P 500 index, which was up over 28%, almost 29% for the last calendar year. The outperformance, however, is driven by the active management and the active allocation to small and mid cap within this portfolio. And that's been very successful in the last year. So if you look at your mid cap managers, they were up 24.5%, or excuse me, that's just one. If you look at your mid cap managers in together, they were actually up about 21% versus 20% for the core benchmark. And the small cap managers together were up about 16% or 26% versus 16% for the small cap core benchmark. Those numbers aren't here on this page directly, but what we do look at is the value and growth managers, and then I'm putting those together. Focusing in on, I'm actually going to work from the bottom up here. So your small cap growth manager, AllianceBernstein, AB, turned in a good result for the quarter and a very good result for the trailing year. They have consistently outperformed over the last 5 years and really been a good complement to the Prudential small cap value portfolio, which had lagged previously, but we were pleased to see performed well in the last year, up 41% versus 28% for the benchmark. Your mid-cap managers, Fidelity Low Price Stock and Janus, both turned in very strong absolute returns for the year, up 17% and 24%. Janus outperformed for the year and Fidelity underperformed. That's actually a reversal from what we'd seen about 2 years ago, where Janus was underperforming and the Fidelity Low Price Stock Fund was outperforming. So again, good complements to each other have turned in good complementary performance over time, which has led to outperformance of the asset category. We do have one manager update specific to the Fidelity Low Price Stock Fund. So it was announced that Joel Tillinghast, who is the longtime portfolio manager of this fund, will be stepping down from his portfolio manager responsibilities at the end of 2023. So we have a pretty long runway on this. The two current co-portfolio managers with Joel that will be stepping up to take over as co-leads are Sam Shamovitz and Morgan Peck. So one thing that we're doing is working with our research team to get to know them a little bit better and monitor, evaluate how this transition is going to go. That said, it is quite significant. Joel has been, the architect of this strategy over time, and so this is something that we wanted to monitor very closly. Again, we're working with our research team to evaluate the change now, and we'll plan to come back to you with a recommendation as to what we think is the best path on a go-forward basis. Moving on to international equity on page 71 here. As Greg mentioned, the international equity composite did trail its benchmark in the last quarter and for the last year. That's a reversal of what we'd seen in 2020, where this was the best performing asset category in your portfolio. Still, for the last year, international equity did produce a positive return, up 6.2% for the portfolio versus 8.3% for the benchmark. Now, when we look at the returns for the individual managers, there was a fair amount of underperformance versus benchmark in the last quarter and year. Again, a reversal of what we've seen in 2020. Much of what was driving this is specific to what was going on in the broad market. So there was a significant divergence between value and growth within international equity, and then emerging markets underperformed developed markets pretty substantially. When we look at the relative performance of your managers versus benchmarks, those were really the driving factors in most for your manager's relative performance. Notably, within the international equity composite, you do allocate to small cap. That's an out of benchmark allocation. Over time, that's certainly been a positive contributor to relative returns. So over the trailing 3 years, up 22%, outperforming the benchmark, but also adding value in terms of having exposure to that corner of the market as an out of benchmark allocation. You heard from T. Rowe Price, your international small cap manager, at one of your recent meetings. They have trailed their benchmark of late. So over the last year, up 7% versus 13% for the benchmark. Much of that due to their allocation to China, which was a driving underperformance within the emerging markets for the recent quarter and year. Your dedicated emerging markets manager, 91, has helped drive longer term outperformance as well. Jay mentioned the fixed income market saw a negative return for the full calendar year. That said, your two managers did protect value versus that negative return over the trailing year. They underperformed in the recent quarter as a result of largely curve positioning and some exposure to the securitized market. But again, notably outperformed for the last year, down 88 basis points, but versus a negative 1.5% return for the Bloomberg Barclays aggregate. Those two managers, Dodge & Cox and PIMCO, continue to work well together and have together outperformed the Bloomberg Barclays aggregate over all longer time periods. We have a line item here for the JP Morgan Infrastructure Fund, but that is a preliminary flat return. So as that result rolls in, we would expect a better return than 0% for the recent quarter, which will benefit the bottom line as well. Your real estate managers, however, had a pretty phenomenal quarter and year. The real estate market in particular more than held up well in the last year, but benefited significantly from appreciation in the market. Together, your real estate managers produced a return of 22% for the last year, and over the recent quarter, up almost 9% just for that recent quarter. One thing that we look at specific to the real estate managers is what percentage of the return is driven by income versus appreciation. Over longer time periods, we would expect appreciation to drive more, income to drive a pretty equal or more higher percentage of the return, but appreciation really has been the driver in the last year. All of that brings us to the total fund returns at the bottom of the page. As Greg mentioned, the total portfolio up about 4.3% in the recent quarter, slightly underperforming the total fund benchmark, and just about matching over the trailing year, up 14.3% versus 14.3% for the benchmark. Longer term returns are very strong, double-digit returns for the trailing 3, 5, 7, and 10-year time periods. And 7.6% versus 7.26% over 15 years annualized. The remaining pages look at the asset class composites versus benchmark and peers. So the domestic equity composite in aggregate has done very well. When we look at the domestic equity portfolios of other public funds, yours is ranked in the top quartile and decile pretty consistently across all long time periods. The international equity composite has struggled. 2020 was an excellent year for the international equity composite. So if we look at the last two calendar years in tandem, it's done very well, but 2021 was more challenged on a relative perspective. The fixed income portfolio has been very steady, pretty consistently right about median among the domestic fixed income portfolios of other public funds, and very consistently ahead of the benchmark, which is the Bloomberg Barclays aggregate. And then lastly, the real estate portfolio is shown on slide 75. as I mentioned, has also been very steady and very strong. So it's certainly been a good allocation, a good diversifier within your total portfolio, and has produced absolute returns that have benefited the bottom line of the portfolio returns over time. Are there any questions on performance or anything you'd like us to get into more specifically? Jerry, it looks like you've got a question.
Sorry, I can't find the questions. Jerry, do you have a question?
I think
you're on mute, Jerry.
James Anderson had a question.
Okay. Both Siegel and I believe Greg talked about our being in a position now where we can take some risk off the table. I believe, Greg, correct me if I'm wrong. And risk has been my concern since I've been on the board, but I've been wrong on every part of it. I mean, we've done very well with a high risk portfolio. But if two of our experts are saying we can reduce some risk, and I do know that our infrastructure purchase by increasing our diversity has been a motion in that direction. But is the suggestion out there now that in some way we should be reducing our risk? Even just a little. So I'm asking Claire and both.
Yeah, Jerry. So I think you're spot on that us building up the real estate and infrastructure allocation is diversifying our portfolio a little more, and that's been intentional to reduce the risk associated with being in the private in the public markets almost exclusively. And then the lowering the overall level of risk, we would have to do a much greater in-depth analysis about your long-term expected return and impact of inflation and all of that before I would come to that conclusion. But I think it's something worthy of consideration and analysis. And so perhaps we could take a look at that.
Nice to meet you. Come on over.
I'm not sure who's not muted, but I see Trustee Anderson. You have a question.
Yes, can you hear me?
Yes.
Greg and Claire, I took the Sackers Berkeley Law School investment class, and last summer, and Thomas Gilbert, I don't know if you're familiar with Thomas Gilbert, who they invite to speak at that. And he was, for a couple of days, he's kind of like a big advocate of even greater simplification of portfolios. Like, for instance, when we look at domestic equities, a Russell 3000 for 10 years is essentially a benchmark. And, ex-US equities are essentially at benchmarks. And he was a big advocate for literally lowering your mental bandwidth and the complexity and the costs and everything associated with even what is a fairly passive portfolio for MCERA, and looking at even taking it a step further than that. Are you guys, is that a discussion that's happening out there? Because clearly, for 10 years, it appears anyway from the numbers that either way we have invested, we would have wound up at the same place. Is that a reasonably accurate statement? And do you see any kind of trends towards that?
Yeah, I do think you're onto something there, Jim. Your portfolio is a lot simpler than other portfolios. So part of it is what do other people look like, and what do you look like? We've kept it pretty simple, and in fact, we have simplified it over the years. I would keep that as a point of reference. The other thing I'd point out is that you have a quarter of your total portfolio in a US index fund, 26%. So we're already expressing that view a little bit. Hey, US large cap market, pretty efficient. Who can have better research on Apple versus Microsoft, right? Are you going to make money there, right? So why spend your active risk there? And instead, we're spending active risk in areas where we believe there to be less efficiencies. And then, so I think our portfolio is pretty simple. I would argue some other portfolios should probably be simpler and not, I've said it before with you all, not chase fads. I think that's a real issue with our industry. And we just generally haven't done that here. The final thing I'll point out is that over the last 10 years, your fund, we take a little bit of active risk, not a crazy amount. You have to take active risk in real estate and infrastructure. There's no index fund out there. And then you've got 25% in the US equity index fund. And then you've got the rest of the portfolio that we express actively. And over the last 10 years, that's added about 15 basis points per annum. So over 10 years, that's 1.5% to 2% added to your value, right? And that's real money. 2% on a $700 million portfolio is real money at the end of the day. So, I guess there are a few thoughts there, Jim.
Thank you. I kind of felt the need to ask the question because it was driven home for a couple of days, literally in the training, that the question of whether or not there is truly any alpha, and whether or not you should be completely indexed and passive. But also at our strategic planning retreat, we talked about the need to try to create more room for the board to address non-investment issues. And I didn't know if we were potentially missing an opportunity to accomplish both of those things.
Thanks, Jim. So, Greg, is there anything else? Yeah. Go ahead.
Those were the key issues we wanted to share with you today.
Okay. Any further trustee comments, or do we have any public comment on investment matters? Do I have anybody who needs to take a break, or do you want to ram through this? Catherine, did I see break there? Okay, I know the meeting looks a little short, but sometimes they go on. So I think we'll say goodbye to Greg and Claire and Jay and Hannah and take about a 10-minute break, and we'll come back at 10 minutes after 10. Okay?
Good seeing you all.
Thank you.
Have a
Good to see you.
Hi, guys.
Fantastic. So we will move on to agenda item number 7, discussion and possible action regarding approval of cost of living adjustment as of April 1, 2022. So Director Rentschler.
Thank you, Chair Smith and trustees. Included in your packets is the letter from Siegel regarding the cost of living adjustments for April 1st of 2022. This is for all non-PEPRA class retirees, which would be tiers 1 through 3 general and 1 and 2 for safety and safety probation. PEPRA tiers do not get a COLA. The CPI change rounds to 7%, and the maximum COLA to grant is 3%. So the 4% will roll into the members' COLA banks, as illustrated on page 2 of the attachment from Siegel. If there are any questions, I'm happy to answer any questions you have, or I can turn it over to Julie for any, or Judy for any public comment.
Trustees, do you have any comments or questions on the materials presented? And
No.
are there any public comments, Judy?
Yes, we do have one.
Okay.
Mr. Almeida.
Can you hear me?
Yes,
Yes.
thank you.
All right. Of course, every year I used to come down there, and now I can't in person, but I just want to express the how thankful I am for these COLA raises, especially this year when our fuel prices have advertised of being raised 40% nationally. In California, they were raised 70%. And even my propane went up 50%. And even my PO box went up 40%. It's just unbelievable what's happening. It is so much appreciated, and I just want to let you know how much it's needed. I don't get a real high amount. If I had a big retirement, I probably wouldn't even worry about it. But I know most people that have worked for the county are in my position, and we're middle class, and these COLA raises mean a lot. So I appreciate the approval of them, and they're much needed, especially this year. Thank you.
Thank you, John, for your comments. It is kind of horrifying to watch all the prices go up at the grocery store and the gas pumps and everywhere else. So do I have a motion to approve? Oops, I'm sorry, Trustee Forrester, I see your hand up.
Oh, I just wanted to bring up what we were discussing at the strategic planning for the PEPRA members, is that because they don't have a COLA, that it's more important that they receive information about 457 plans and know how to sort of shore up their retirement along with the county retirement to make themselves in a better standing position by the time they retire. So just wanted to bring up that we, part of our discussion was educating members more and bringing more of that information to them, so those people that are in PEPRA understand these alternative options.
Thank you, Trustee Forrester. That's great. Trustee Jurdy. Oops, I'm sorry. Did Trustee Anderson? I saw your hand up at once, but it went away.
Yeah, I was premature. I was going to make a motion.
Well, let's get Trustee Jurdy's and then we'll come back to you.
Well,
Yeah.
First I want to thank Trustee Forrester for bringing that up, that, we do want to do as much as we can to educate the members about multiple legs to their retirement stool, just so they can be well supported in retirement. And just wanted to note that, we're using the Western region for the CPI because multiple studies have shown that that was the most comparable to Mendocino County. And I think it's important that we continue to stick with one CPI and not bounce around. So I'm glad that we're doing that. And just wanted to note that the retirees are, of course, also enrolled in Social Security, and Social Security, which is the national CPI, has a CPI on their Social Security of 5.9% this year. So again, it's just important for people to be planning their retirement, not relying entirely on the county pension system for their retirement, but recognize that they should be looking at both the county retirement, Social Security, and any other retirement income that they can develop so that they can live comfortably.
Thank you, Trustee Judy. So Trustee Anderson, do you want to make a motion?
As a retiree representative, I would really be thankful to be able to make the motion to accept the COLA recommendation from Siegel.
Is there a second?
I'll second.
Any further comments from the trustees?
My only question is this an accept or is this to implement the recommendation? I mean, are we just accepting?
This is to approve the granting of the 3% as recommended in the Siegel document. This is an action item to adopt the 3%.
Then Jim, are you willing to change your motion to adopt rather than accept?
Yeah, thank you. Yes, I would amend that to adopt.
And as the seconder, I will I will second that.
Okay, I'll
Any
take a
further
roll call
discussion?
vote.
Okay,
Ms. Schapmire,
Yes.
Ms. Forrester,
Yes.
Ms. Cavanis,
Catherine,
you're
Muted.
muted.
Yes.
thank you. Mr. Jurdy,
Yes.
Ms. Smith,
Yes.
Mr. Cromer,
Aye.
Mr. Shoemaker, Ms. Harris,
aye.
and Mr. Anderson.
Yes.
Thank you. So we will move on to agenda item number 8, which is our quarterly budget update. I don't know if that's directly to Robert or Doris. Do you want to say something first?
I will turn it over to Robert.
Okay, thank you.
Trustees, you have before you the quarterly budget update. I assume you've all read the memo, and so I'd be willing to answer any questions that you had.
Any questions from trustees? Any public comment? Oh, Trustee Anderson?
Not a question, but a quick thank you to Robert once again for a very thorough explanation of all the variances and in the budget. I really appreciate that.
Yes, it's much easier to read with the explanation cover sheet. So thank you, Robert.
And there's no public comment.
Okay, thank you. Thank you, Robert, for the update. We will move on then to agenda item number 9, discussion and possible action regarding Board of Retirement Charter. Director Rentschler.
Thank you, Chair Smith, members of the board. It is time for the regular review of the Retirement Board Charter. It's been like 3 years since you reviewed this last time. I did have our board counsel review the charter to make sure that there weren't any necessary updates to the section on fiduciary duty and things of that nature. He indicated that he had no suggested changes. The rest of the changes in this are all minor edits and then just indexing it for the date the board last reviewed it and eventually adopts it. Did you have any questions regarding the charter?
I was surprised we still have policies and procedures out there probably that haven't had the change in the executive director title. So anyway, that's good that we're getting those fixed. Anybody, any trustee have a comment there? And are there any public comments?
There
Yes,
is no
Director.
public comment.
Thank you. Director Rentschler, were you going to say something else?
That might have been an edit from before and may or may not have been approved, and that's why I left it as an edit on this one. I was unsure if that had previously been adopted with that change. I apologize, I hadn't confirmed that, but I did leave it as an edit in this one.
That's good. So I will need a motion to, to adopt the charter as amended.
I'll make a motion to adopt the charter as amended.
I'll second.
Thank you. Roll call vote then, Judy?
Ms. Schapmire,
Yes.
Ms. Forrester,
Yes.
Ms. Cavness,
Yes.
Mr. Turdy,
Yes.
Ms. Smith,
Yes.
Mr. Cromer,
Aye.
Ms. Harris,
Aye.
and Mr. Anderson.
Yes.
Approved.
Thank you. Moving on to agenda item number 10, we have discussion regarding the administrative report. So Director Rentschler.
Thank you, Chair Smith, members of the board. In the administrative update, I wanted to let you know that while we do strongly recommend appointments to meet with our retirement specialists, we are open to walk-in traffic, and we're serving members at our lobby walk-up window. We continue to utilize Zoom, phone, US mail, and email in service of our members. That was expanded during COVID, and we continue to use those methods of communication. We will be moving back to a hybrid type board meeting at the request of the board. So starting with the March meeting, our office chambers will be open to Board of Trustee members who wish to attend in person. You would be required, if the masking mandate is still in effect at the county, to mask during your time in the meeting unless you're the one speaking. But we will offer that meeting via Zoom and then also hybrid with our live boardroom. Tax documents were mailed out to retirees on January 31st. They're also available through our member self-serve portal. And as a follow-up to our meeting last week for the strategic plan, Mosaic Governance Advisors LLC will be bringing back the first draft for a read of their strategic plan at the March 16th meeting. So we'll have that first read March and then a second read to incorporate any changes requested by the board and adoption at the April meeting tentatively. I am putting together a bit of a training calendar to help ensure that we count all of the educational efforts and help provide you with some educational alternatives during our regularly scheduled meetings. By the way, at today's meeting, the Callan Market Market Options Report is actually qualified as an educational item, and you will all receive credit for that in your totals. So the serial lists actually 10 different areas that qualify as educational areas that the board can receive training in. I will be putting together a training calendar. I believe there was a draft of it attached to the administrative report. I would like to know if there are any specific topics or items that board members would like to have as an educational presentation so that it can be incorporated into the upcoming calendar. And I'll pause there for any comments or questions.
Yes, Trustee Anderson.
Just one, thank you, Director Rentschler. On the March meeting, are there any health order limits to the number of people, or if you're just willing to abide by the mask rule, could anyone attend?
I will double check the county health orders to see if there have been any other changes. The last health order did have a recommendation of indoor masking for all members, but they still suggested to keep group below, I believe it was 10 or 12. But I would say if we want to provide for some social distancing, because our boardroom is such a tight fit that we may not want to have all members return, but that's really up to the trustees. If we could kind of get a head count as we approach the March meeting date, so we know who may be attending in public versus who may be attending via Zoom, it might help us organize the room and make sure that we're ready to accommodate anybody who wishes to attend in person.
And the rules may change by then as well.
The rules may change.
Yes. Trustee Jurdy.
I will help to keep the numbers down by zooming in from Fort Bragg.
I think maybe the week before when the agenda comes out, or a few days, if you wouldn't mind just sending out that question. I won't make a decision yet until we hear the health rules at that time.
Okay, if
Trustee
there aren't
Forrest.
any
Oh, I'm
comments
sorry.
on the educational portion, I'd just like to mention that if you have not already submitted your payment for the fiduciary waiver of recourse to Judy, please go ahead and get that submitted. It is $9 again this year. And if you have not submitted your Form 700 filing, please send a copy to Judy. I believe the deadline for that is April 1st. And the other item attached to the administrator report was the SACRS legislative update. As a reminder, as mentioned at last month's regular meeting, if you wished to submit your name in nomination for the SACRS Board of Direction, that deadline is March 4th, and you, I believe, have up until then to submit your name if you wanted to be considered by their nomination committee. That's everything, unless you have any other additional comments or questions.
Trustee Forrester.
So during last week's strategic planning, we were all able to get together at a meeting, except for Trustee Cavanis, and she joined us via Zoom. And I found it to be more productive and allowed us to have a better understanding, I guess, of who we are and how we can work together and have just a better feeling about working cohesively as a group. So I say a lot is missed through these Zoom meetings. And I really felt that last week when we were all able to get together. It's been a long time. So I guess I was on the board for probably 3 or 4 months before COVID happened. And now we've been like this ever since. We've had a couple attempts at this where there's been a hybrid meeting, and we've had, Jerry has gone to the boardroom. Meanwhile, we've been on Zoom. And I'll say I've had a real hard time hearing her and Doris from the chamber or the boardroom while we were all on Zoom. So I'm not sure if the OWL is going to be utilized this time and if that was better at our strategic planning, but I think that's a challenge for having some board members in the boardroom. But you know, I'll go there because I want to reopen. I believe that we should be open as much as possible. And so I'll attend, given I'm hoping that there's some better sound.
We will make use of the meeting OWL, which hopefully will improve the sound and the video of the person speaking who happens to be in the board conference room. Again, if you're attending in the conference room and you're using your iPad for viewing materials, you want to make sure that you aren't logged into the actual Zoom meeting, because it creates some feedback and conflict there. But absolutely, you know, I've been here just under 2 years, and last week's strategic planning meeting was the first time that I'd seen most of you in person, except for maybe once or twice in passing to say hello. But there are certainly advantages to being able to get together to work.
And I'll just add that the masking does create a difficulty in hearing each other clearly. So we'll just have to do the best we can with that. The OWL audio isn't as clear as your individual audio when you participate remotely in an individual basis.
Might ask Catherine how it was for you hearing us at the strategic planning session last week.
You know, it was pretty good, but there were a couple of times where I did have a hard time, you know, making out what somebody was saying. But overall, I would say, you know, it was pretty good. But of course, and today, with all of us using our own, I guess, individual way of participating, it's clearer, you know. And then also, people had to wear the masks who were there in person, so that I think that may rather than the technical, it was partly, being masked and being remote that created the problem. But overall, I'm just happy we can meet at all.
Yes. Yeah.
Grateful. Yeah.
I do find
Good
that
point.
trying to listen to people when they have the mask on is certainly more difficult for me. So I appreciate the Zoom meetings because it makes it a little easier for me to pick up on what's going on. I can hear better. I can see your lips move. But there are certain advantages to getting together in person too.
I did want to add to what Doris said about educational requirements. For those of you who serve on other boards and commissions, or basically you're required to do so as part of your position with the county, a lot of times those types of trainings can qualify for educational hours with this board. So if you have something that you've taken within the last year that you're interested in earning credit for, go ahead and submit it. Also, with the Form 700s, I don't have access to what an elected official may be required to submit online to the FPPC. So I still need to receive a copy of that from you. Same thing would go with the ethics and harassment trainings that the county provides to you as an employer. Or if you take those independently at an educational seminar, if you could forward those on to me as well. Thanks.
Thanks, Judy. Trustee Cromer.
Yeah, my question is related to what Judy just said, and I believe last year I did 2 originals on the 700 because I had to do it for my primary job and also for the Retirement Association. So you will accept just a copy of what I file with the county, and I don't have to fill out 2? Mm-hmm. Okay. I just wanted to make sure on that because last year I'd done it differently. Thank you.
And you will be contacting those who need to turn one in if we've forgotten whether we have or not?
Yeah, I'll send an email.
Okay, thanks. Director Rentschler.
Thank you, Chair Smith. I just checked the county latest health order and it says it will be reevaluated on March 15th. Our meeting is on the 16th. So you can stay up to date on the health orders that will be posted on March 15th to see if there's any significant change. But we'll move forward as previously stated.
As a hybrid. Any further comments on the administrative report? So our final agenda item then is any general board member discussion. Anything else you'd like to bring forward?
Kathy?
Yes, Trustee Harris.
I'd just like to bring up something that we did at CalSTRS that I think might be helpful. And the last thing I want to do is have our staff have more work, so there's no hurry on this. But as I read through our agenda materials prior to a meeting, and then as we all participate, particularly in the investment area, some kind of a glossary or a set of definitions, as we're talking about adding alpha and the SERL and the various things that sort of become a part of your vocabulary if you regularly deal with these terms, are probably Greek to people who may either want to attend a meeting or pick up the video of what we're doing. And we just had something that was included in our packets or available through staff for our members who might want to watch and figure out what we're doing here, that would just be simple definitions of the acronyms that might help folks. And I don't know if that's something other board members would consider to be useful, but it certainly was useful to me when I was a board member with the state. So I just want to throw that idea out there.
some days I hear more of those than others. And today it was in Jay's performance, I believe, when there were lots of acronyms that I'm sure he thought we all knew, but anyway. So I have several hands up. So let's go with Director Jurdy and then Director Cavness and Mr. Revelis.
I want to thank Jerry, the educator, to reminding us that we need to eliminate jargon from our presentations. And I think in particular, probably Greg's presentations kind of stand out as being kind of jargon free. I don't know, Jerry, if you consider that true, but I think if you've seen the CalSTRS meetings or CalPERS meetings, probably Greg does a better job than most, and kind of keeping it kind of in the everyday language.
No, he's great. He's great. Yeah, and the CalSTRS meetings, the agendas were 1,500 pages also. But, you know, I was just thinking of something that would continue to evolve as new terms arise.
Director Cavness.
Well, I think it's what Jerry's brought up is very thoughtful and kind thing to do, especially for people who are, you know, tuning in. And what I've noticed, you know, overall throughout my lifetime, if I am confronted with new acronyms and I don't know what an acronym actually stands for, I may lose the value of a good portion of the presentation being stuck on, well, what did that mean? So I really appreciate that. Thank you.
Thanks, Catherine.
Mr. Revelis, and then Director Renshaw.
Yeah, I did want to point out, and it may not be exactly what Trustee Harris was expecting, but the extended Callan report does have some of that information at the end of it. Also, again, it may not be exactly what she was looking for, but there's a little bit of definitions for some of the terms in the Callan reports at the end of that.
Thank you. Director Renshaw.
Thank you, Chair Smith. I would like to offer that we could perhaps put together some of the most common acronyms and make it available as a link on the agenda page, so it's there at the top of the agenda page with every meeting packets as they get added. And we can add to that list of acronyms over time as other items come up, but we can certainly start with some of the most common, like the CIRL and UAAL and things of that nature, and build out on it. Then I know at last week's presentation, there was like the OCIO or something in the ESG presentation, and I kept forgetting what it meant. I looked it up at least twice, just so I knew what it was when it came by. And so yes, I understand that the use of acronyms is a bad habit for our industry, and we can certainly try to put together a little summary table of them.
That'd be great, Doris. Thanks.
For many industries, not just ours. Yes, Judy, and then Jim.
I just wanted to add that we do have a glossary of terms from Callan. I know they do try to include some of that in their reports. The glossary we have is from 2018, so I'm sure we could probably ask them to update that, and then we can add our Doris's additional items to that and post that.
Thank
That'd
you.
be great.
Trustee Anderson.
I was just going to mention also that the CIRL itself starts off, I think the first whole chapter is a glossary. I don't know how, I don't recall how reader friendly it is, but you may be able to pull some items out of that as well.
Wonderful.
You have that memorized, huh? Any other comments from board members? Then I would say that we can adjourn the meeting, and our next meeting is our regularly scheduled meeting will be Wednesday, March 16th, 2022 at 8:30, and some of us will probably be in the room and some on Zoom. Meeting is adjourned.
Thank you.
Thank you.
Thank you. Bye, Sherry.
Sherry.
Bye.
Take care,
Bye,
everybody.
Sherry.